Adding and modifying accounts in the chart of accounts is one of the areas that students make the most errors in. The focus on this chapter in Chapter 3 is to make sure that you can identify the correct account type and detail type needed to add an account. I'm going to use my sample company to demonstrate how to add a new account to the chart of accounts. First, click the gear icon in the top right-hand corner of the screen. Then click Chart of Accounts. Once your Chart of Accounts screen comes up, click New to add a new account. Now, we're going to start by adding a checking account. And you need to be really careful when you're adding cash accounts, because the one that you select as the checking account is the account that your checks will be written out of, and it's the account that your deposits will go into when you enter them in QuickBooks Online. So the name of the account is checking, the account type is bank, and then the detail type is checking. When I enter the checking detail type, that tells QuickBooks that that's where the checks are coming out of and the deposits are going into. We have an opening balance in this account of $5,000, and the date that we're going to enter is as of 12/31/2024. Now, I'm not going to, you would normally save, but there's already an account in here called checking, so I'm just going to cancel. The next account, and this one's tricky, is a fixed asset account called machinery and equipment. So I'm going to add the machinery and equipment. And this is a fixed asset account. Now, they're tricky. All fixed assets are a little tricky because they have an original cost account, what we initially paid for the item, and also an accumulated depreciation. But we're just going to start by adding machinery and equipment, and that is a fixed asset, and I believe there's a machinery and equipment detail type. So we'll select that. We're not going to put an original cost in right now. We're going to save that for a minute. So we'll hit save. Now I want to put in the associated original cost with the machinery and equipment. So I'm going to click New, and the account name will be Original Cost, and I'm just going to put machinery and equipment next to it so I can distinguish that from other fixed asset accounts. All right, and that's going to be a fixed asset. It is machinery and equipment, and I'm making it a sub-account. If I click this button to make it a sub-account, it's going to go, sub means underneath. So the parent account, I want it underneath the machinery and equipment account. The original cost is $10,000, and that is as of 12/31/2024. You'll have to watch your dates because the company that we're working with is kind of in the past, so be careful with the dates. And let's see, we'll just save that. Right now we need to enter the accumulated depreciation account that goes underneath the machinery and equipment. So I'll enter New, and I'm going to call that Accumulated Depreciation, Machinery and Equipment. And when you're entering names in your chart of accounts, make sure the spelling is correct and make sure the beginning of each word is capitalized. because you don't want your chart of accounts looking sloppy. You want them to look consistent. So the account type is fixed asset, and the detail type is accumulated depreciation. And the opening balance in the accumulated depreciation is 1,000, and that's as of 12/31/2024. Oops, and we have to make that a sub-account. And we have to indicate that we want it underneath machinery and equipment. So if we come down and look at our chart of accounts now, we'll see the main account, machinery and equipment, the accumulated depreciation of 1,000, and then the original cost of 10,000. Notice that the machinery and equipment is giving us the net or the book value of the machinery and equipment. That's the original cost less the accumulated depreciation. The next account that we will add is notes payable. The account type is a long-term liability. Now, never ever classify anything as accounts payable except accounts payable, because accounts payable, there can only be one, because when you send somebody a bill, it credits accounts payable. The system does, and it has to know which account is the accounts payable account. So always only have one accounts payable and don't classify any other account as accounts payable. So in this case, we've listed a long-term liability and notes payable just popped up. But when you list the account type, your possibilities for that type of account in the detail type show up. So in that case, we'll put in notes payable. The balance is 12,000 as of 12/31/2024. Save that. And then we're going to add a common stock account. Now, common stock is just like a capital account for a corporation. It's what the owners of the corporation, called stockholders, pay for the stock or pay into the company. So the account type will be an equity account, and then you can find the common stock detail type. And then just, let's see if there's a balance. Yes, there's a $100 balance. And save. Oops, there's already a common stock account, so it wouldn't save it, so I'm going to cancel that one. Next, we'll add a few more accounts, but this time we're going to add them as we're in the middle of a transaction. So if you are entering an invoice or entering a bill or a journal entry, you can add an account as you need it. So in this case, I'm going to add some accounts with a journal entry. The date is 12/31/24. Always double check your dates on everything, because if your dates are off, then your financial statements will not be correct. Okay, I'm going to add the accounts receivable account. So I need accounts receivable here, and I already have it, but let's say I did not have the accounts receivable account. I'm going to add new. And notice that the new account screen pops up. So I'll enter accounts receivable. The account type is accounts receivable, and the detail type is accounts receivable. Now, Just like accounts payable, accounts receivable should only have one account, because when you send someone an invoice, accounts receivable is debited, and it needs to know which account is the accounts receivable account, and there should be only one. So make sure you only have one accounts receivable account that is designated to be debited or credited for accounts receivable transactions. So all I would have to do is click Save. I already have that account, so I'm going to cancel it. In this case, accounts receivable has a $925 balance. So if you do not know which accounts have normal debits and which accounts have normal credits, you could miss this transaction and transactions like them. You have to know that accounts receivable is an asset, so if you're given a $925 balance, it should be a $925 debit. Now, if you enter an accounts receivable on the books, QuickBooks needs to know who owes your company that money. So that's the reason we have the name column over here, and we will enter Benson's RC. Now, you may or may not have Benson's RC already. If you don't, you can add new. And your new customer will come up, because you know customers are related to accounts receivable. Vendors are related to accounts payable. So make sure that if you're adding someone for accounts receivable, it's a customer and not a vendor or an employee. So customer should be here at the top, and the company name in this case is Benson's. Okay, so we already have this on our books, so I'm just going to close out of it. There's a lot of other information. It should be fine if you omit that information, because I don't believe it's given in the text. Okay, so that will be Benson's. The next account that we'll need to add is prepaid expenses. So we already have that account, but we could add new and enter prepaid expenses. And this is why you're knowing your account types and detail types is so important. From Accounting 1 and also Accounting 2, you should know prepaid expenses is classified as an other current asset. And you would then go in the detail type and find the account prepaid expenses. Okay, we already have that account, so I'm going to close it and click on the prepaid expenses account. Prepaid expenses has a balance of $2,400. Since it is an asset, the balance needs to go on the debit side. Assets have a normal debit balance. The third account that I'm going to add is accounts payable. Okay, we already have the accounts payable account, but we'll go through the process. The account type is accounts payable. There is only one account that can have the account type accounts payable, and that's accounts payable. So never classify any account as accounts payable unless it's accounts payable, as accounts receivable unless it is accounts receivable, as a cash, a bank, or a checking account unless they are actually a cash, check, or banking account. Sometimes students just do that because it's the first thing that pops up, but they have to be properly classified. So I'm going to cancel out of that and just choose accounts payable. Now accounts payable has a normal credit balance. It is a liability. So if you don't know that, you could enter this transaction incorrectly. It's very important. And your employer is going to expect you to know those things as well. Now, if we owe someone money, we have to designate who that money is owed to. So just like accounts receivable, we need to enter a vendor for our accounts payable. And in this case, the vendor is Kyosho. Now, it's not a customer, so you have to be careful right here on the screen and select vendor because it's associated with accounts payable. And the company name is Kyosho. Okay, I think we already have that in this particular company, so I'm going to close that out and choose Kyosho. Now this journal entry is out of balance. I know, and you know, and QuickBooks Online knows that journal entries have to balance. Their debits have to equal their credits. So on the fourth line, we're going to add the account opening balance equity. This opening balance equity account just serves as an offsetting account for our opening balances. So when we put a debit of $925 in accounts receivable, it has to have a credit to some account, and that account is opening balance equity. Now, once we get all our beginning balances entered, we'll take the balance in opening balance equity, and we will close that amount out to the retained earnings account. And I think you are shown how to do that in your Wild Water Sports account in Chapter 3. So QuickBooks has already put the correct offsetting amount in here because it knew that this transaction had to balance out. So it entered a credit of $14.25. So now that we have all our debits and credits in balance, we can save, and those accounts will be added to our chart of accounts, and the balances will be added to our trial balance. So if we scroll down our chart of accounts, you'll see the accounts and amounts that we added with our journal entry and with the chart of accounts screen. Now there are a few things I want to warn you about before we finish. Do not duplicate your accounts in the chart of accounts. If you already have an account set up, and another transaction needs that account, don't add another account. Use the account that you already have. So double check your chart of accounts before adding a new account to make sure you don't already have that in your chart of accounts. If you add a duplicate account, that will be a deduction. And also, if you think you've made an error on one of your accounts, do not delete the account. If you want to change an account, just go to the account, click the arrow, and click Edit, and see if you can make the needed change. Never delete an account, because students will try to delete accounts that already have balances. That means that one side of the account is getting deleted and the other side is not, and it throws QuickBooks Online out of balance, and it will start making random journal entries to try to balance out your company. So if you think you've made an error, please contact me and I will try to go into your account and make the correction for you. So just remember, do not delete accounts. I hope this helps.